All right, option basics. This is all about options trading and the fundamentals. Okay, what is an option? Well, the option is the right to buy a certain stock for a fixed price over a fixed period of time. It grants the right, but not the obligation, to buy. For this right, you pay a premium, which is a fee, which is usually pennies to the dollar. Here's an example. Suppose you got Microsoft stock that's trading for $180 a share. Now, an option gives you the right, grants you the right to buy that at 180 for all the way up to, let's say, this Friday. So no matter what Microsoft does, you can still buy it at $180 a share at any time during that period. For that, you get an options contract, which is handled through your broker, and it goes for, let's say, $1 a share. So for $1 per share, you get the right to buy Microsoft 180 no matter what. So this is where it gets interesting. Suppose Microsoft goes up $2. It goes up from 180 to 182 by Friday. Well, guess what? The option value also goes up $2 because the stock went up $2. So whatever the option was worth at the time of the contract started, it's worth $2 more all of a sudden. Now, you see why that's so interesting, because the options were $1 a share. And now if Microsoft goes up $2, it's now $182, but the dollar a share for the option is worth $3, which is a 300% gain. That's quite a difference with the 1.3% gain you'd have on the straight stock. So the cost is also ridiculously different. To buy 100 shares of Microsoft stock would cost you $1,800, and options would cost $100. But in each case, you make $200 profit if it went up to 182. Yet you're only risking 100 to make the same amount of money. Here's the deal. Options trade like stocks through your online broker. You just buy and sell options just as you would shares of stock. You see, you have the right, but not the obligation to buy the stock, which means you don't ever really buy the stock unless you really, really want to. You just buy the option, and then you sell it if it goes way up in value, and you make a fat profit. You see that. You can effectively trade with relatively small amounts for potentially large gains. Now, a lot of you will be thinking, well, then it's a no-brainer, right? I mean, who in the world would want to buy the straight stock for almost $2,000 when for $100 they get the same exact leverage? Shouldn't it be a no-brainer to do options? Well, no, not really. It's not a total no-brainer, and here's why. Because options decay. Here's what happens. You get that option contract, you pay it $1 per share, but over time, when it approaches expiration, that premium becomes less and less and less, and by the time you hit expiration, if the stock has done nothing, it's gone sideways, you lose. You lose 100% of your money. The option is now worthless. Whereas if you own the straight shares of Microsoft, it stays $180, you haven't lost anything. That tells me that the option trade is a higher risk in that respect. The stock has to make a big move. You only win if the stock makes a favorable move quickly. Now, let's cover the option types real quick. A call option is what we've been talking about. It's the right, but not the obligation, to buy a stock for a certain price for a fixed period of time. For this right, you are charged a premium. The price you reserve to buy the stock is called the strike price. So the examples we gave, $180 for that stock was the strike price. If the amount of the premium is determined by several factors, including the time to expiration, the likelihood of the stock reaching or surpassing the strike. There's also what we call the put option. The put option is similar, but it's the right, but not the obligation, to sell a stock for a certain price for a fixed period of time. For this right, you're charged a premium, just like the call option. The price you reserve to sell the stock is called the strike price. The amount of the premium is determined by several factors, including time to expiration and the likelihood of the stock reaching or going below the strike. Note that in a put option, it has to go below the strike price to be worth more. Call options increase in value if the underlying stock advances in price. Put options increase in value if the underlying stock falls in price, which, by the way, is how you make money on a down market, on a stock that crashes. If the underlying stock price is at or surpasses the strike price, it is said to be in the money. You want to hear that term thrown around in the options world? The total value of the option is its premium plus the amount, if any, it is in the money. Options that are close to or in the money are more expensive than those that are well out of the money. Very cheap options, well out of the money, are not likely to reach the strike price and hence are likely to expire worthless. That's my key point I wanted to make. You guys are going to find options and go, wow, look at these. They're only 5 cents each. Well, that's probably because it is so far from the money, it is so far from the strike price that it's not likely going to make it before expiration. And thus, you've thrown your money away. You almost for sure have those expire worthless. All right?